Imagine you're sitting in a coffee shop, maybe sipping on a latte, and you overhear a conversation about a company's financial performance. You hear terms like EBIT and EBITDA tossed around, and while they sound important, they also sound a bit intimidating. But what if I told you that understanding these two metrics could give you insight into whether a business is thriving or just surviving? Let's break it down together, step by step, in a way that's engaging, relatable, and easy to grasp. First off, let's talk about EBIT, which stands for earnings before interest and taxes. Think of EBIT as the heartbeat of a company's core operations. It tells us how well a business is performing before the financial burdens of interest and taxes come into play. Imagine you own a bakery. Your sales from delicious pastries, cupcakes, and bread are your revenue. From that revenue, you subtract the costs of flour, sugar, and labor. What you're left with is your operational profit, or EBIT. It's a clear snapshot of how efficiently your bakery is running, without the noise of financial obligations clouding the picture. Now, let's say your bakery made a net profit of $100,000 last year, but you also had to pay $10,000 in interest on a loan and $20,000 in taxes. To find your EBIT, you simply add those expenses back to your net profit. So $100,000 plus $10,000 plus $20,000 gives you an EBIT of $130,000. This number tells you that before those financial obligations, your bakery was actually bringing in a solid profit from its operations. It's like taking a deep breath and realizing, okay, my bakery is doing well on its own. Now, let's spice things up with EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. This metric digs even deeper into the operational efficiency of a business by excluding non-cash expenses like depreciation and amortization. Think of depreciation as the wear and tear on your baking equipment over time. Amortization is similar, but typically relates to intangible assets, like a trademark for your bakery's name. Continuing with our bakery example, let's say you had $5,000 in depreciation and $2,000 in amortization expenses. To calculate EBITDA, you would take your EBIT of $130,000 and add back those non-cash expenses. So $130,000 plus $5,000 plus $2,000 gives you an EBITDA of $137,000. This means your bakery isn't just making money, it's generating cash flow from its core operations, which is a fantastic sign for potential investors or lenders. Now, why should you care about EBIT and EBITDA? Well, these metrics are crucial for anyone looking to assess a company's financial health. Investors, for instance, can use these figures to compare different businesses within the same industry. If you're looking to invest in a bakery, you want to know which one has the stronger operational performance. By comparing EBIT and EBITDA across similar bakeries, you can spot the ones that are truly thriving and not just surviving on paper. For entrepreneurs and managers, keeping an eye on EBIT and EBITDA can highlight areas for improvement. If your bakery's EBIT is looking good, but your EBITDA is lagging, it might be time to evaluate your equipment and see if there are ways to optimize your operations. Maybe it's time to invest in new ovens that are more energy efficient, which could reduce your depreciation expenses in the long run. But hold on a second, while EBIT and EBITDA are valuable tools, they're not the end-all be-all. They have their limitations. For instance, these metrics don't account for working capital needs or capital expenditures. Let's say you need to buy more flour or invest in marketing. Those costs are essential for growth, but won't show up in EBIT or EBITDA calculations. So, it's crucial to look at these metrics in conjunction with other financial indicators to get a complete picture of a company's health. Now, let's dive into where you can find EBIT and EBITDA on financial statements. They typically reside in the income statement, which summarizes a company's revenues and expenses. To calculate EBIT, you start with net profit, add back interest and tax expenses, and voila, you've got your EBIT. For EBITDA, you take your EBIT and add back depreciation and amortization expenses. Simple, right? Let's take a moment to consider the practical significance of these metrics. They allow stakeholders, whether you're an investor, a manager, or a curious entrepreneur, to make informed decisions. If you're evaluating a potential investment, strong EBIT and EBITDA figures can be a green light, indicating that the company is generating healthy profits from its operations. Conversely, if those numbers are weak, it might be a red flag, signaling that the business could be struggling. So, as we wrap up, remember this: EBIT and EBITDA are like the windows into a company's soul. They reveal how well a business is performing at its core, stripped of financial noise. Understanding these metrics can empower you to make smarter decisions, whether you're investing, managing, or simply curious about the business world. Next time you hear someone mention EBIT or EBITDA, you'll know exactly what they're talking about. You'll be able to join the conversation with confidence, whether you're at a coffee shop or a business meeting. And who knows, you might even impress someone with your newfound knowledge. So keep exploring the world of finance and let these metrics guide you toward understanding the true essence of a company's financial health. Cheers to your financial literacy journey.